My last video focused upon the statement of purpose portion of the financial plan. I stated that without knowing what you need your portfolio to do for you, it will be impossible to select the right assets for the job. It's a little like trying to drive a screw into a board with a hammer. Can it be done? Yes. Will it turn out well? No. In this video, I will start to discuss the assets that are part of my personal plan. I won't be able to cover them all in a single video, much less how they work together, so stay tuned. Before I do, I wanted to remind everyone what my personal portfolio objectives are. 1. Supplement what is likely to be a lower income stream with a reliable stream of income from the portfolio in constant CPI-adjusted dollar terms. 2. Not require us to ever need to adjust our withdrawals from the portfolio downward. 3. Grow the income stream over time at a rate sufficient to satisfy the requirements of Phase 3. With this in mind, I will start to discuss components one at a time. I'm going to start with the common stock component. I know this is going to create a gasp among my viewers. Rest assured, no, I have not all of a sudden become bearish on gold. Yes, I still have a substantial amount of my assets in gold. But gold by itself will not meet the objectives outlined here. The key part of that to emphasize is the by itself part. I will get to gold. You just need to indulge me and give me a little time. With that said, I'm going to read from my financial plan while focusing on a graph included in the plan. Here goes. It is a well-known adage that a person cannot outlive their money if only interest and dividends are spent. In other words, capital not touched. While that might have been the case decades ago, when bonds were denominated in gold-backed dollars, it is not the case now. Inflation will gradually eat away at the purchasing power of bond interest. It is the case, however, that stock dividends can be spent without worrying about depleting the portfolio. One caveat to this is that individual company stock is dangerous because even the most seemingly solid companies can go, and have gone, bankrupt. So it is important to adopt a well-diversified stock portfolio. Choosing index funds that replicate the Russell 1000 Value Index, the CRSP Value Index, and the S&P 900 Value Index will not only provide the much-needed diversification, but will also result in a higher dividend income stream because the constituents are older, well-established businesses that tend to pay out more of their earnings as dividends. As of late July, the Russell 1000 Value Index yields 2.79%, whereas the S&P 500 index yields only 1.78%. Value stocks will pay an income stream that is 57% higher than the market average. So our stock component will consist of value index funds. One of the problems with deriving income from stocks is that although dividends generally go up over time, they have also been known to be reduced during difficult economic times. This can be seen in the chart below, showing the per-share dividend history of the iShares Russell 1000 Value Index ETF going back to its conception in the year 2000. Notice that dividends grew reliably for the first 8 years of its life, leading up to the financial crisis of 2008 to 2009. Per-share dividends decreased from 60 cents to 35 cents, nearly a 50% reduction. Eventually, the dividends paid recovered back to the late 2007 level of 60 cents per share, but it took 7 years to get back to even. Clearly, some type of protection against the downside reduction in dividend income is needed. Without it, we would have faced a very significant decline in income for a substantial period of time. Granted, the economic period of the Great Recession was the worst we have seen since the Great Depression. However, it serves as a pretty good example of what can happen. So we'll need some insurance against it, which is to be covered in the cash reserve section. Notice that despite the drop, dividends increased over the prior 20-year period. The average rate of increase from start to finish was 7% per year in CPI-adjusted terms, roughly tripling dividend income. This increase was available to anyone who could stay the course in stocks. The trick was to survive long enough and get through the economic crisis. This high rate of increase may not be repeated, but it is reasonable to assume that since these companies retain some of their earnings for growth, that we'll see some level of increase in dividend payout in the future. Okay, I'm finished reading the income generation section of my financial plan and wanted to provide some commentary. What are the pitfalls of stocks? We've already eliminated the problem of individual companies going bankrupt by using a big basket of securities. And we've also filtered out many of the stocks that are in a mania by using value indexes. But there are still problems. One problem is that with a dividend yield of about 3%, it would require a huge amount of money to live only on dividends. This is a problem not faced by the super wealthy, but it is a problem for most of us because who is going to be able to save up 30 times their yearly salary? Well, this is not a problem actually. For one, most people who are even going to consider a staged retirement are super savers. Their spending is already significantly lower than their salary. Additionally, in phase 2, there will still be some income. Dividends only have to make up for a portion of spending. In my personal situation, my spending level is about half of my current salary, and my savings is sufficient that dividends are about 15% of my salary. This means that dividends are about 30% of my spending level. Income needs to only supply the other 70%. And this means that I can cut my income to about a third of its current level and not have to worry about spending any of my capital. I only hold about 5 times my salary right now in stocks. The low dividend payments may or may not be a problem in phase 3. In phase 3, there is no working income. Chances are that capital will need to be spent. But by my calculations, according to my plan, the growth of capital will be sufficient to support phase 3, even if Social Security is greatly reduced. The bigger immediate problem is that dividends can be cut during bad economic times. For example, during the economic crisis that started in 2008, dividend payments from the Russell 1000 Value Index were reduced nearly 50% and did not attain their former levels for 7 years. A person relying solely upon dividend income would be in a really bad spot if this scenario occurred again. Of course, another problem is that stock prices can fluctuate wildly over time. Usually market price levels and dividend payments move in unison, so a person who is counting on dividend payments alone will find the need to sell some stock at a period of time when prices are likely to be low. And this is exactly what we want to avoid, because it can lead to a failure of a financial plan. Fortunately, there are ways to solve these two problems. The solution involves other assets. And yes, one of those assets is gold. Stay tuned. Over the next few days, I will show how these other assets do their job. My last video focused upon the statement